Hello, and welcome back to Accounting Zero to Hero. In this video, we're diving into Management Defined Performance Measures, or MPMs, under IFRS 18. If you enjoy learning about accounting, IFRS, and consolidation, don't forget to subscribe to the channel. It helps us reach more and more people for every upload. So let's start. This video is part of a series of uploads about IFRS 18. In this video number 3, we discuss about Management Defined Performance Measures. In our previous videos, we discussed the general requirements for the new income statement format under IFRS 18. For video number 2, we discussed the exceptions to the general requirements we discussed in the first video upload. And now we're discussing management-defined performance measures. For the next few videos, we will be discussing the aggregation and disaggregation requirements, the impact on other IFRS accounting standards, and the transition requirements when we're finally going to transition from IS1, the previous standard, to IFRS 18. So now let's discuss basic definitions of what is an MPM, or what is a management-defined performance measure. MPMs are subtotals of income and expenses that reflect management's unique view of the entity's performance as a whole. These measures often appear in public communications like earnings call or investor presentations. They provide stakeholders with a clearer understanding of how management evaluates their business, so it is an entity-specific measure. What sets MPMs apart is that they are not standard subtotals defined by IFRS, such as gross profit or net income. Instead, they are tailored or customized by management to highlight specific aspects of the company's performance. So, if you think of it this way, if the subtotals of the IFRS standards help the entity communicate performance measures that are comparable and consistent to the industry, to different companies, MPMs, or management defined performance measures, are entity specific, and it promotes an understanding of entity specific performance measures for a specific entity. That's why even you will learn later that one of the disclosure requirements of an MPM is that there should be a caveat that these MPMs may not be entirely comparable to other companies. Because the identification of a management-defined performance measure triggers additional disclosure requirements under IFRS 18, the standard provided some guidance on when a measure is considered an MPM or not. This is directly coming from the additional supporting materials provided in the illustrative examples accompanying the new standard. So first, we have here a series of questions that you can ask on each of the performance measures being communicated to the public. So, is the measure a subtotal of income and expenses? If the answer is no, then it's not an MPM. You don't have to disclose anything. If the answer is yes, you then have to ask, is that measure, even though it's a measure of income and subtotal of income and expenses, is the measure used in public communications outside financial statements? So it's a very important thing to remember, public communications. For purposes of this term, the standard specifically ruled out the use of social media, oral communications, and the transcripts of these oral communications. So basically, the public communications should be ways other than these three that was identified or ruled out by the standard: investor presentations or other ways of communicating, financial performance to the public outside of the financial statements. If the answer is yes to this question, then you have to ask yourself, is the measure listed in paragraph 118, or is it specifically required to be presented or disclosed by IFRS accounting standards? So it doesn't have to be IFRS 18. Is this subtotal already required by another standard like IFRS 16 or IS 19, or is this measure specifically excluded as an MPM by IFRS 18? We will discuss that later on a section about what is not an MPM. So if it is not specifically excluded, or if it is not required by another IFRS accounting standard, then it's possible that it is an MPM. If it is excluded, then of course it's not an MPM. You don't have to do anything. You don't have to disclose anything new. However, if all of these three have already been passed, and you're here in this fourth sort of tier of the questions or of the checklist, you have to ask yourself, does the measure communicate management's view of an aspect of the financial performance of the entity as a whole? This one, there is already a presumption that the answer is yes. You have to remember that. Because if you are already saying that you have a measure of a subtotal of income and expenses, you're using it to communicate to the public other than the financial statements, and that measure is not listed as an excluded measure under IFRS 18, or it is not required by another IFRS standard, there is already a presumption that okay, that is already an MPM. So you have to go straight here. However, the standard is saying that okay, although you passed all of these three questions, this presumption that it is already an MPM is rebuttable. You have to have a rebuttable presumption. You have to have supportable information that although you are doing all of this, it is not a management defined performance measure, or this measure is not really communicating communicating a view of management on the performance of the entity. So basically, if all of these things have passed, then that specific measure is an MPM, and you have to do specific disclosures on that MPM. So you have to do this for every type of measure that you are using to communicate financial performance of the entity. So what are examples of management-defined performance measures, or MPMs? We have to know that the standard does not specifically tell you what are examples of MPMs, because this is entity-specific, and it would actually defeat the purpose of it being an entity-specific measure. However, in the accompanying illustrative examples of IFRS 18, there are some examples given by IFRS itself, ISB itself, on how to present different management-defined performance measures. The examples that were provided are adjusted operating profit and adjusted profit from continuing operations. The keyword here is adjusted because the operating profit, you can already see it in the income statement, right? Then the word adjusted means that it is an MPM, meaning that from the examples of ISB, they had to remove some non-recurring items from the operating profit to show the real performance of the entity during the year without non-recurring items. So this example, we will see it in the next slides. So most importantly, let's talk about what is not a management-defined performance measure. The list of what is not an MPM can be derived from the basic definitions of what is a management-defined performance measure. For example, non-financial metrics are excluded from MPM. For example, customer satisfaction scores. This is not a subtotal of income and expenses. This is not a financial measure. So you don't have to disclose in the financial statements how you computed your non-financial metrics. Second one are liquidity measures. For example, free cash flows. It is not a subtotal of income and expenses. It is not a measure of financial performance. So you can still use it in your management reports or other reports, but you don't have to add disclosures to explain how it is. So now we have here the ratios. The ratios are technically not subtotals of income and expenses because, how you compute the ratios, you normally have a numerator and a denominator. However, the standard is saying that if that ratio includes an MPM in one of the formulas, like a numerator is the adjusted operating profit, for example, then you are still required to disclose how you computed this adjusted operating profit that you used for the ratio. You don't have to explain the ratio itself, but you have to explain a portion of the ratio. You have what is not an MPM, subtotals of only income or only expenses. For example, net revenues or total operating expenses. It should be a subtotal of both income and expenses. And last but not the least, items specifically excluded by paragraph 118. This one we will be discussing one by one. What are the items that paragraph 118 is specifically excluding? So this specific paragraph details what are the items that IFRS 18 is considering as not an MPM. Basically, the idea is that if if it is a well-known subtotal, you don't really have to explain it anymore, like gross profit or loss. Gross profit or loss is not a required subtotal of the income statement, but people generally already know what it is, so you don't have to explain it. And this is coming from the basis for conclusions of ISB. And other items that are already defined by other IFRS accounting standards. For example, operating profit or loss before depreciation, amortization, and impairments within the scope of IS 36. Operating profit or loss in income and expenses from all investments accounted for using the equity method. This is not very common, but the ISB mentioned that some companies actually present this in the income statement. So in case they present it, it's not considered as a management defined performance measure, basically because you already know what is the nature of this subtotal. You don't have to have entity specific knowledge. So what else do we have? So the next one, it says subtotal comprising operating profit or loss and all income and expenses classified in the investing category for entities applying paragraph 73. So this is very specific to the discussion we had on the last video, link about the income and expenses of type 1 liabilities that are not related to financing to customers, because for these types of income and expenses for type 1 liabilities, and you belong to the entities that has a specified main business activity of financing customers, you have the option of putting income and expenses into operating or financing. If you put it in the operating category, then you are not allowed, quote unquote on the allowed, you are not allowed to use the subtotal profit before financing and income taxes, because it will mislead the users of the financial statements that it is a profit before financing, but you already had financing items in your operating profit, even though they're not related to financing customers as a business. So, however, you have to know that even though you are not allowed to use that subtotal, that specific subtotal, profit before financing and income taxes, IFRS 18 allows entities to use a differently named subtotal. So, this differently named subtotal should not in any way be similar to the term profit before financing and income taxes. They can name it however they want. But the standard is saying that if they use this option of still putting a subtotal, that is not an MPM. I hope that's clear. And then the last two are just normal subtotals required by IFRS. So we have profit or loss before income taxes and profit or loss from continuing operations. Okay, so we have been talking a lot about the different disclosure requirements. So if it is an MPM, what should we do? And why is it that you have to have additional information if you identify a measure as an MPM? So number one, all of the MPMs that you have identified for a company should be in a single note. All identified MPMs should be presented in a single note in the financial statements. That's very important, because the standard setters wanted all information to be concentrated in one area. You cannot split the different MPMs into different notes. For example, if an MPM is related to the leases, you cannot put it in all the explanation in the lease and another MPM in another note. So you have to combine all MPMs in one single note. However, according to interpretations that I have seen, if you have only one MPM, you can put it in a combination of the related note that it has, as long as all of the information are already there. You don't have to refer to different sections of the financial statements to understand what is that MPM. You have to also remember that it is not prohibited to present an MPM in the face of the financial statements. An MPM is not a required total. However, if it will assist in presenting a useful structured summary of the financial statements, you can actually present it in the face. It is allowed. It is not prohibited. So, what should be included in this single note? There are two things. it should, as a general, so not specifying on which specific MPMs that you have, as a general note, there should be a statement saying that MPMs reflect management's view of the entity's performance as a whole, not a subset of the entity, but the entity as a whole, especially if it's a consolidated financial statements. There should also be, number two, a caution that these MPMs may not be directly comparable to other entities. So this is what I was talking about earlier, that the MPMs is okay that it's not very comparable because it is entity specific and it is actually mentioned in the note itself. So what are the descriptions that we need to put for each MPM? The previous ones were more general descriptions of management defined performance measures, but for each MPM it must be clearly labeled and it must be described. Number one, it must disclose the aspect of financial performance communicated by the MPM. Lastly, it must disclose the calculation methodology, ensuring users understand exactly how the MPM is calculated. Lastly, each MPM must be reconciled to the most directly comparable IFRS defined subtotal or total. This ensures that adjustments made to derive the MPM are fully transparent and that users of the financial statements will be able to follow how the MPM was computed in relation to the other parts of the financial statements. This example that you see on the screen, this is what I was talking about. This is coming from the illustrative examples of ISB. So the MPM that they have identified is the adjusted operating profit and adjusted profit from continuing operations. The closest subtotal or total from IFRS is the operating profit and profit from continuing operations. The last requirement that we need to put, apart from disclosing the aspect of financial performance that is being explained by the MPM and discussing the calculation methodologies, we should have a reconciliation from the closest IFRS subtotal. So here we're saying that in order to arrive at the MPM, the entity, this example, is removing the non-recurring items, the impairment losses, restructuring expenses, and gains on disposal of PPE, because these are not very common during the year. So that the 65 million MPM describes the performance of the entity without any non-recurring items. So they're using this to communicate to external stakeholders in public communications. So yeah. And another thing that companies need to disclose in this reconciliation is the income tax effects of each adjustment and the non-controlling interest impact of each adjustment. The reason of this is that although you see it's not really they don't really need to disclose the totals, the total income tax expense impact or total NCI impact, unless it is the MPM itself. The reason here is that the ISB or the standard setters wanted the users of the financial statements to have an option on how to use the MPM to compute for the measures themselves. For example, if they are computing for earnings per share, they can include the parent share on the earnings per share calculation. So this is something that this is the flexibility that ISB is offering to the users of the financial statements, but not specifically being required to be put by the entities. So we are just required to put the income tax expense, the income tax impact of each reconciling item and the NCI impact of each reconciling item. So one last thing that I wanted to discuss about this topic is that that there are different changes to the entity's financial performance, different changes to how we measure performance. What happens when an entity makes changes to its MPMs? IFRS 18 has specific requirements to maintain transparency and comparability. So what are the different changes that IFRS 18 has mentioned? For example, if there are changes in how an MPM is calculated, because before you are disclosing specific methodologies of calculation, if something changes in those, that is a change that should be disclosed. when a new MPM is being introduced, like for example, in the previous years, you're not using one type of one type of measure in your public communications, and now it is being made relevant, you have to consider that as a change. The stopping of the use of a previously disclosed management defined performance measure, if you're using it last year and now you're not using it anymore, and changes in how income tax effects are determined in the reconciliation. If you can remember, you have to put the income tax expense here for each reconciling item. So if there's a change in the way the income tax expense is being calculated, then you have it's one of the changes that is being required to be disclosed by the standard. Why is it so? Because the income tax expense is a bit complicated to compute sometimes for some entities. The ISB has allowed entities to use simplified calculations of income tax expenses, or they are also allowed to use more complicated ways or alternative ways. So whatever the way of computation is, if it changes, then it has to be disclosed. So for each of these changes, we have to disclose the nature of the change and its related effects. We have to disclose the reason why we are changing it, and we have to put restated comparative information. However, the comparative information, there is a little caveat that if it is impracticable to do so, then you don't have to put it. But if it is, then it is required to put a comparative MPM. If, for example, if the MPM is new, you have to put its equivalent in the prior year as a new disclosure. These requirements ensure that stakeholders understand the changes of how entities or how management views the financial performance of a company over time. So all of these things that we discussed about MPMs, this may not be fully applicable to everyone because not all companies disclose financial measures in a public manner. For example, if it's a private entity and doesn't really disclose anything to the public, then most of most of the companies who do not do public communications, they are most likely excluded from an MPM requirement. But the standard is not saying that this MPM requirement is only for public entities. That's why there is sort of a checklist that you have to follow. It's not saying that only public entities or listed entities should do this. So that is a very good thing to remember. And that's a wrap for our third video on IFRS 18. We have covered management defined performance measures. Don't forget to subscribe and share this video with your fellow accounting enthusiasts. Thank you.